Hi and welcome back to Cheeky Crypto. My name is Nick, and today guys we're going to be jumping down into the technical analysis for BTC, taking a look at what has been going on most recently and what I would expect to happen next. As I get into this video, if you find it useful and informative, smash the like button, I do appreciate that. If you're new to the channel, why not go ahead and subscribe? Tap the bell, selecting all the notifications will keep you up to date with all the updates here at Cheeky Crypto. If you haven't yet joined us in Discord, check it out, linked in the description down below. It's a fantastic community talking crypto 24/7. It's completely free, and I don't think you'll be disappointed by what you find down there. And it's the first place we actually go to notify you of everything that's going on in the crypto space. So keep a finger on the pulse of crypto by joining us down in Discord. I'm going to go through two things in this video. We're going to be taking a look at Elliott Wave theory. That's going to be the first part of this video, and then the second part we're going to be taking a look at smart money concepts, and then we'll probably try to blend the two things together to give us a good idea as to kind of where we think things are most likely going to be going. So let's jump right down into it. Here we have Bitcoin paired up with USDT on the hourly chart, and Binance is the data source. Now we can see that from an Elliott Wave theory point of view, we have the ability to push up higher. Okay, this is this range up here. We've been talking about this recently. This is $27,000 to $28,000. Okay, and this is pretty much only really possible because we have this 5-wave structure here. Okay, if you start with 5 waves, you must end in 5 waves. Okay, and so if we've had 5 waves here, and we're in this ranging market, which I'll talk about in a moment, then we should be ending up with 5 waves to the upside. Now that's on this wave count. Now it is equally possible that this 5-wave structure is actually a part of something else. Okay, so we want to be open-minded here because this could be a multitude of different structures. Now, as I've drawn it, it would look like we have this target of $27,000 to $28,000. However, as I said, if you start with 5 waves, you end in 5 waves. It's also possible that this 5 waves here, it could be included inside a flat corrective structure, and that would be in here, A, B, and then C like this, in irregular flat, for example. There's no running flat, so we know it's not that, and it could also be a zigzag pattern from over here, where we kind of have this long-winded move upwards, down, then up again. Okay, so it's possible in that kind of regard as well. But for the most part, I think it's reasonably a good expectation to think of this as a starting position rather than an ending position. But I just wanted to kind of put that out there to say that it's possible that I am wrong, and it's possible that this structure, although shows us with a move towards $27,000 to $28,000, may not actually materialize. It's just one of a possible series of different potential moves according to Elliott Wave theory. I think this is the most probable one, so I'm going to leave it like this, but just be aware that there's a couple of things that it could also be. Now, as we kind of expand up here, we have these 2 dashed lines that we drew on yesterday. This is the low one down at the bottom here. That's 23,339. And then at the top, we have the 25,250. Essentially, what is the price doing? Well, the price is basically going in between these 2 levels right in here. Okay, I'll draw this big yellow box on. You can kind of see it's right in here. This is the definition of a ranging market. Price is stuck between 2 places, okay, and basically it is just sideways trading. Now, when it comes to a ranging market like this, it is an incredibly foolish thing to do is to trade it, right? You don't normally trade, and most professional traders would avoid trading ranging markets, and that is because it doesn't really tell you too much about the direction of the move. They usually say the trend is your friend. You trade in the direction of the trend. Now, there's many different ways to classify a trend. A 5-wave structure would be definition of an Elliott Wave theory trend. You have EMAs and things like that that can help you define a trend. You have smart money concepts with whether you are doing a change of characteristics or a break of structures, and you have trends you can follow. Okay, and in the case of a ranging market, you don't really have that. You have a move upwards, and then a collapse, and a move upwards, and then another collapse, and you are stuck in this market here. So most professional traders would avoid trading a ranging market. It's just not really worth the hassle. You don't necessarily know if you're going to be getting that big move upwards or that big move downwards. So essentially what you wait for is you wait for the actual market to decide which direction it is going in. And in this particular example, I have the expectation that we are going to come down briefly and break this low, tricking people into thinking that we can short the market only to actually rally on up afterwards. I reckon both of these are going to happen. So let's take a look at this, right? If we come down, we've pushed up, and then we're coming back down again. By Elliott Wave theory standard, this would be another double bottom like we had a double top, and then we can move up. However, if we reflect on this C wave structure here, then we could actually argue that what we've got to do is actually come down a little bit deeper than that double bottom. And if I would go ahead and measure this out, you would see that we'd have this estimated target just down here, which I'll go ahead and put this little yellow box on, which is basically going to be 22,598 and 22,967. Okay, however, it's probably worth noting that the minimum expectation would be that double bottom, and that would be 23,339. In fact, it would be more specifically, if we really wanted to be really accurate about it, it would be 23,574. However, I think that would be less likely. So I think essentially here, if we were to reflect on this, that would be where our C wave would end approximately, our B wave end in that range, and then we get this break to the upside. Now, depending on how deep the B wave goes, will depend on how big and how high that C wave goes. That's dependent on this, for example. It should be the measurement of our A wave. Typically, that would be what you would expect. You would expect an A to be typically the same size, or C to be typically the same size as C. So if we go ahead onto this higher range of this C wave box, for example, we'd see that we'd be at about 27, and we might be able to push that 28 a little bit. Okay, so essentially that's kind of where you would end up with. So from an Elliott wave theory point of view, it looks reasonably bullish, right? But we are in this range in market, so we can't be 100% confident that we're definitely going to be completing this C wave anytime soon. And, you know, a range in market until it kind of completes, it is what it is, and we should be very, very cautious. This is one of the other problems with Elliott wave theory. I say problem, it's not really a problem, it's just one of those things that's an observation. B waves are incredibly unpredictable, and this is not because, you know, you just say, oh, B waves are unpredictable. It's because a B wave can be pretty much any corrective structure, and because it can be anything, it could be a double three, it could be a triple three, it could be a triple zigzag, right? It could go on for quite a long period of time and still be technically a definition of a wave B. Okay, it's not necessarily as simple as just a 3 waves drop and you're done. Sometimes it is, and sometimes it's incredibly complicated. Could be even an Elliott wave triangle inside that B position. So we want to be a little bit cautious when it comes to these ranging markets and with the B waves, but for the most part, I think this is the most logical and the most, I guess the most obvious one that's going to play out considering all the other variables. So when we take a look at our oscillator, the stochastic RSI, on this hourly chart, we can see that we're heading into the oversold area. And again, that would support that we're running out of downward momentum, but we've still got a little bit more to go. On the 4-hourly chart, we can see that there is enough momentum to take us down into this low range, where we could then talk about maybe a run to the upside. The 8-hour chart is already oversold, so that's a good sign. The 12 hours there, the 16-hour is there, the 20-hour is there, the daily is coming down and still has quite a way to go, but you could quite easily just bounce up temporarily. And of course, we're overbought on the weekly. So there's stuff that has to happen on the large time frame still that hasn't changed. But for the most part, from an Elliott wave theory point of view, my expectations are a small move down and then a slightly bigger move to the upside. But what about Smart Money Concepts? Well, Smart Money Concepts has a very similar setup here. We can see that we have on here a premium range right at the top, okay, and it is a week high. And we have a discounted low down here, which is a strong low. Okay, so the expectation is that we hold the lows. Of course, that is 23,339. Which arguably I think is actually going to get lost personally. But we can also see that there's a few interesting things that have occurred here. So one, we have this low over this side, and we have this one just here, which is a higher low. Okay, so although we kind of see this setup as potentially bullish, I would look at this as not necessarily seeing it as it is. I think that we have a potential move here, as I said, of a 3-wave structural move down. That would then allow us to kind of complete out our structures, and would allow us then to talk about that move upwards into that week high. Now, the other thing I think is probably worth noting is where we were yesterday. If I go ahead and take a look at this from yesterday, when we did our video on Smart Money Concepts, we can see that we had the fair value gaps, these ones here, these green boxes. These are your imbalances in the order books. Now, a lot of people get these confused. They just think you have to, you know, there's no reason to have to come down here. Essentially, these are created because too much buying pressure was pushed up here and there was no one selling in this little gap. So the institutional or big funds that were buying at this time can't continue buying if there were no buyers, no sellers in this area to buy it from, right? So price comes up here, they realize that they've left the gap behind, they have to ease off, right? So there's 2 in this particular case. We can see that they were pushing the price up and then they've had to cool off, right? So price wants to naturally come down and come back into these areas and fill them because there's no liquidity there. So basically, the institutional player who pushed the price up there now lets the price naturally fall back down. And if I hit play on this and just kind of bring it across, we can kind of see that they all got hit, including that one that was up there as the institutional player had pushed the price down as there was a little bit of buying pressure in there. And you can kind of see that how they operated, right? So if I go ahead and turn that off, there we go. We can now see that we filled all of those gaps that were left behind, those imbalances that we were speaking about yesterday. New ones were created and were also filled. And if we take a look at this right in here, this little yellow box area is now our supply area. Okay, so I'm going to write the word supply just there. And I will actually make that white. I don't know why that's yellow. There we go. So this area is now our supply. This is symbolized because what we have here are all these big wicks. These wicks here basically say that price went up here and an immense amount of selling pressure pushed the price down. And inside this yellow box, we have no closed positions. We just have wicks. This is telling us that there's a huge amount of supply entering into the market when price comes into this range, and therefore we come on down. And the same is true for these green areas down here. These are order blocks. You can see that prices come in and it moves right back out again. This puts us in a ranging market, as we were saying, right? We're in that ranging market. We can kind of see it in here, trapped between the supply and the demand. One of these is going to win out and we're going to get pushed in the opposite direction, right? So it's going to be an interesting move to, or an interesting time to kind of see how that plays out. As we said, we know where �値𝗓𝗪𝗧𝗧 theory sits with this, and we kind of can see here that we have the supply just below the equilibrium, and we are looking at a strong low at the moment, but my expectations are that we probably will end up coming back down to this gap that was left behind. This gap being 23,000 to 23,200. There's also one down here at around that $22,500. These are no coincidences that from an �値𝗓𝗪𝗧𝗧 theory point of view and a smart money concepts point of view, that these things all kind of collide together. Here we go. We can see that our expectations would be right in here on �値𝗓𝗪𝗧𝗧 theory, 22,600, 22,900 approximately. And then you can see that we might even just have to take out these areas right here before we move on up. Okay, so those gaps down at the bottom there look pretty juicy. Now, as we obviously said, we had that 5-wave structure upwards and we'll be looking for a break upwards at a later date up towards that $27,000, $28,000. What do we see? Well, on that journey, we would have this gap that would also get filled out as well. Okay, so from a smart money concepts point of view and an �値𝗓𝗪𝗧𝗧 theory point of view, I think these things are coming together quite nicely. Our stochastics remain the same. So essentially here we are looking at slightly further downside on the smaller timeframes with a slightly bigger push on the larger ones. But do not forget the bigger macro piece, which I'll probably talk about this afternoon, that essentially does look pretty bearish. So short term, potentially bullish, but I think ultimately the macros are indicating that we have much further to go to the downside before we can even think about some kind of progression upwards. The other positives on the smart money concepts is that we have had a positive change of characteristic, although minor, right in here on equilibrium. I think this will be short-lived though. This is a minor change, and this minor change in characteristic I think is going to basically get flagged up down here as we kind of lose these lows. That's how I would see it. But you know, as I said before, it's all possible that the market just reacts differently, but essentially that is my take on it at the moment. If you found this useful and informative, smash that like button. I do appreciate that. If you're new to the channel, then subscribe, tap the bell, select all the notifications, and stay up to date with everything that we do here at Cheeky Crypto. With all that said, done out of the way, have a fantastic day, guys, and I'll catch you all in the next one.